Hi, and welcome to this morning's early global view. It is currently 6:45 a.m. U.S. Central Time on Thursday, May 5th, 2016. And we wanted to wait until this morning for a major global view because we wanted all of the most important data prior to Friday's U.S. employment report to be out of the way. And certainly the data has remained weakish on balance, even if there was some improvement in U.S. data coming out of the day yesterday on Wednesday. But what we also know is that the weaker data, as you can see from the short-term charts of the S&P 500, is now generating more weakness than not. In other words, the old bad news is good news central bank psychology isn't working after 2 weeks ago. Still very accommodative ECB. In the last week, still accommodative Fed, and even though the BOJ disappointed a bit by not moving further into NIRP, negative interest rate policy, and also any expansion of its quantitative easing, it basically is still being very accommodative and wanted to see what would transpire off the last move in that regard. So the bottom line is something we have been saying for a while, and more intensely so since the later part of last year. The central bank ability to restore growth probably was never reasonable, with a lack of structural reform from the political class, and the central bank moves in the negative rates are the end of the line. They're out of policy tools, and with no prospect of structural reform, we think equities are quite vulnerable. So we have to ask, what does all this mean to the markets? And as usual, we have our short-term charts, 60-minute on the left, 30-minute on the right, U.S. S&P 500 future. And this all relates back to something we're going to see more of on the intermediate-term charts, of course. But going back a couple weeks ago, there was an upbreak out of a very significant downward channel on the weekly chart. The overall channel since last summer's highs, that is a very orderly and clear parallel trend line to form a channel. Projections, basing lines down in the low 1800s from back in August and again January, February, and the top line across the tops going back into the late last year as well. And that upbreak was from 2078. Now, 2075 to 85 was also a very important historic congestion that, in fact, the market pushed above going back 2 weeks ago on Wednesday, prior to the ECB, and even as accommodative the ECB was, the market didn't care. Now, after holding once again with some slippage down into the 2075 area, could never quite get going above 85 in spite of the constructive influence of a still accommodative FOMC last Wednesday, and held up in spite of BOJ disappointment last Thursday right in that range. But by late Thursday, this market, maybe delayed reaction to the idea the BOJ was not being accommodative, or that the FOMC and ECB's accommodation wasn't going to help, came under pressure and broke down out of a couple of different short-term projections, one of which from the time it gapped up going back to Wednesday the 13th, and that put it above the 2060 area. That was very important resistance during the previous phase in its historic congestion. It formed a head and shoulders, very well formed, a lot of conformance, as they say. Left shoulder had right shoulder, and that neckline came in just below the 2078 upbreak on the weekly chart. Similarly, you had your overall channel, and this is with the parallel topping line back here that goes back so far it's not constructive to look at it on the hourly, but your broader channel up on the hourly chart from the low 1800 low, the last one in mid-February before the market pushed up. That channel had never been challenged on any dips. Well, the market broke down below it, going back to last week, Thursday, and stayed under some pressure on Friday. And the key here was that even with somewhat better PMIs, mixed PMIs and somewhat better data elsewhere, the best this market could do on the way back up was to get back up to that 2077, 75, 78 area Monday before the major gap lower on those weak Chinese and UK PMIs on Tuesday. So as of right now, this market has some very serious resistance up there, fresh down breaks, and a major failed up break. And if we expand this chart once again, overrunning the gap above 60, actually left a low of 64.5 that day, back to the close at 55.70 was a very important indication of this market wanting to weaken, and the further support is not till down at 2035 to 32. That's the interim. The much bigger support is 2010 to 2020. And that pretty much does it for the short-term view of the S&P 500.